Hey everybody, Dave here, Hidden Freedom Investing, and welcome back to another video. In this video, I want to go over my top 3 favorite income ETFs. Now there's a lot of different things that we could unpack here with all of these income ETFs. They are very popular, and they might not be right for everybody. Some people they might be right for, but I'm going to go over my top 3 favorite in this video. So let's not waste any time. Let's go ahead and get started. So let's just talk a little bit about income ETFs in general. So a lot of them pay monthly. Okay, a lot of people are attracted because they do pay monthly. A lot of them are just have different strategies as well. Every income ETF, and I'm talking about like RYLD, XYLD, DIVO, BST, Jeppy, NUSI, okay, and now QYLD, I think I mentioned that one. But so all these popular income ETFs, they all have slightly different strategies. They might be using different indexes in the background. They might have different option strategies as well. They are not all created equally. So that's one thing you need to know right there. And you might even ask, well, how are they all taxed? Well, they all are taxed. Some might be taxed the same, some are taxed slightly differently. Some could all just be return on capital. Some could be a mix of return on capital, short-term capital gains, long-term capital gains / dividends. Okay, so until I go through a full year with all the income ETFs that I have, I really don't want to talk too much in depth on taxes because honestly it's so complicated and it's very hard to find information on it, and a lot of other people, there's a lot of misinformation out there in YouTube videos as well. So I really don't want to talk much about it. When I go through a full year, which basically next year, next tax season, so next year when I go through a full year, I will make a full comprehensive video on basically every income ETF I have and how it is taxed, okay? Because I know a lot of people are always interested in that, but in general, return on capital is a good thing, especially if you keep investing back into the income ETF, although theoretically it'd probably take several years, if not a decade, to reduce the cost basis down to 0. But if you keep investing back into that ETF, then the cost basis should really never go to 0. You should never really have to worry about taxes. But for all those other ones that have long-term capital gains, short-term capital gains, or maybe even qualified dividends or something like that, you got to look at the perspectives of the ETF. But in general, like I said, this video is not really to talk about the taxes. It's just talk about the favorite income ETFs that are my favorite. Now I'm just going over 3 of them today. Obviously, when you start looking at my dividend portfolio here, you'll notice that I actually have more than those 3. But I'm going to tell you the reason why I like these 3 in particularly. So let's go ahead and dive into my dividend portfolio here. And just to let you know, there's still a few weeks left. If you open an M1 account using my referral link, you'll still get $50. I'll get $50. The 3 income ETFs I'm going to talk about in this video are in M1, so you could add all 3 of those in M1 if you want. It's a great deal. It's basically 50% return on your money because you only need to deposit $100. The link will be down in the description or the first pinned comment. All right, we are looking at the overview page of my dividend portfolio here, and as you can see, obviously the market's had a pretty rough week. Now it only shows $400 down today, but yesterday was like a $6,600 down day, and that's just what you run into. The more money you get invested, then obviously those big down days really take a toll on you. But this week, just in general, in the options account and my dividend portfolio just took a hit, and that's fine. We need to have pullbacks every so often, which allows for the market to go higher. Now I've heard that there's trillions of dollars on the sideline in cash right now in money market accounts and stuff that are waiting to go in the market. So that'd be kind of good to have a 5%, 10% pullback where some of that capital can come out of those money markets. They get paid nothing. They're getting paid squiddly dot, okay, squiddly diddly do out of those money market accounts that are paying like 0.4%. So, and inflation's 5% or something probably right now. So they're losing money, okay? So a little 5 or 10% pullback would be great. I don't know what's going to happen, but right now we're kind of at the start of a pullback. But it could just get bought up too. So who freaking knows, right? BTFD. All right, so right now, let's go over the number 1 position in my dividend portfolio. And we're going to scroll down here. And my number one position in my dividend portfolio is NUSI. Okay, so that's the largest position in my dividend portfolio. $119,000 across the two accounts. I got over 4,199 shares, and I'm up about, what, 3.3% for a $3,800 gain. So that is one of my top 3 favorite income ETFs, NUSI. And NUSI, if you're not, aware of what NUSI does, NUSI basically holds some stocks, and they also run options, a caller strategy. So they're actually selling naked calls, and they're also selling, actually they're buying puts on the downside as a hedge. Okay, so that's called a collared strategy, and they're running that against the NDX. Okay, so they actually own QQQs, or the NASDAQ stocks, and then they actually run the collar strategy against the NDX itself. Okay, now they do modify that strategy. It's not fixed, okay? So the gap between the call side and the put side is not fixed every month, okay? I've seen it where it's 5%, I've seen it where it's 10%. So I think it all depends on, where they think the market's going, and they might, do a 10% downside to reduce the actual, I guess it's a drag on the portfolio, right? So if you lower it down more, it is going to be less of a drag on the portfolio. If you come up and it's closer together, it's going to actually be more of a drag on the portfolio, so they actually make less. Okay, so that is a monthly pair as well. Let's go and look at the performance year to date at this time on NUSI. So here we are looking at NUSI right here. It is kind of a fugly chart, but that's kind of what you get with some of these income ETFs, but that's fine. This is not going to outperform the Qs or anything like that because you have that hedge, right? So it is crash protection. If the market drops 30% in a month or something like that, then NUSI's not going to drop 30% that month. Most likely, they might drop 10% or 15% or something like that. So that's what you get out of NUSI. A little bit of downside protection there. Now, if it's a slow bleed or something like that, or like a long-term depression / recession, recession, I don't even know how to say that. If we're in a long-term recession, or a bear market where the market goes down for a year straight, then it's really not going to protect you very well in that case there. You might get a little bit of a protection out of it, but it's not going to really give you the protection if it dropped like say 30% in 2 weeks or something like that, right? Like we kind of have had in March of 2020. So scrolling down right here, right now NUSI has a 7.65% yield. It pays monthly. And right now, year to date is up 3.56%. So yeah, so the stock, the income ETF itself is up 3.56%, which is obviously dragging behind the Qs. But you add up the 7 plus 3 over there comes out to almost about 11%, right? So, or maybe a little over 11%, which is actually not too shabby, right? You got a little protection there, and you have obviously a little bit of upside as well, the 3.56%, plus you get the monthly payment, the yield of 7.56%. So, and you got a lot of good stocks in there. It's not going to be as volatile probably as the overall market, but it is what it is. So that one right now is my top favorite, or one of my top favorites. I'm not going to say it's my top favorite. I just have a top 3 that I like. Okay, so if we compare that against the Qs, and this is the Qs right now, as I was saying earlier, I looked at this on Sunday on our live stream, that it looks kind of ugly. It looked like we were kind of topping out, and I'm like, market could go higher, but at the same time, it could also be a start of a pullback. And then, right now, kind of we're testing that 50-period moving average. Today's candle was okay, but it definitely doesn't show that the downside is done, because in my opinion, we should put in a reversal candle in. Like this little candle right here is kind of a reversal candle. This candle right here, that's technically not one, but like this candle over here is kind of a reversal candle. That candle right there is not really a reversal candle in my opinion. But so right now the Qs are up 16% year to date. So that's pretty impressive. But as you can see, NUSI is actually obviously not even coming close to what the Qs are doing. Okay, now technically by the end of the year, we don't know where it's going to end, but NUSI could end up at about 11 or 12 or 13% or something like that, depending on where the market goes. So that's actually not bad though, right? What is your favorite income ETF? Comment below. Go ahead and like and subscribe and set that bell notification. Looking back here at my dividend portfolio, and my next favorite dividend stock out of the top 3 favorite dividend / income ETFs is Jeppy. Okay, now Jeppy is the second largest holding in my dividend portfolio. Got over $61,000 in this particular position, and I have intentions of building all these out even more, $100,000 to $150,000 going forward, probably by, I don't know, say maybe of April of next year, May of next year. They should be, a lot of them should be above $100,000 to $150,000. Right now, Jeppy has $3,400 gain in it with almost a 6% return across those 2 portfolios, over 989 shares. Now, Jeppy is a very interesting income ETF, and they're not really, can't be really compared with any other income ETF. Okay, now they do hold stocks, some real quality positions in there, S&P 500 type stocks, and then they run some options against some ELNs, equity link notes. I'm not really going to go into detail about equity link notes, link notes. And there's about 20% of the portfolio that's into the equity link notes. So it should reduce the volatility considerably on Jeppy. We should have quite a bit of upside. It's not going to perform as well as the S&P 500, the SPY, obviously, but the volatility should be reduced. We should still get some good income, monthly income, by the way, because Jeppy is also a monthly income ETF. And we also get the income from the options against the ETNs, not ETNs, ELNs. Don't get that confused. I made that mistake before. ELNs, not ETNs. Okay, so Jeppy can't be compared with anything else out there. Okay, QYLD, XYLD, nothing like that. So that one doesn't have a lot of history, but it came from a mutual fund. So, and the mutual fund had like a minimum of $1 million to invest in it, so they made an ETF out of it. So the mutual fund had a lot more history behind it, but this particular ETF here is just over a year old at this point. So it is what it is, but right now it is the second largest position in my dividend portfolio. So let's go ahead and compare that against the Q and this P500. Actually, I won't compare it against the Qs, but so let's bring up Jeppy here. All right, we brought up Jeppy here, and look at this here. So it's kind of fallen the S&P 500 a little bit there. So it actually looks like it's doing pretty well. Just looking at the chart right here, it's not as fugly as NUSI is, and obviously, like I said, NUSI is a completely different animal, right? This is a monthly payer. Right now, the yield is 7.57%. And granted, these yields are coming from Finviz, so they may be off a little bit, especially since this is a monthly payer. They pay out what they make. They don't pay out a fixed income or anything like that, possibly like what QYLD does. So in this case here, this particular income ETF is up 11.64%. That's pretty darn amazing in my opinion, okay? Now, obviously it's not as good as the Qs being up 16% right here, but still, that's only off about 5%, right? And obviously the Qs really pays no dividend at all. It's pretty much non-obsolete, right? Non-obsolete. So right now, so if you added that yield about the end of the year, all right, it's probably already paid out, what, 3% or something like that. So it's not too far off from the Qs, honestly. Excuse me, not the Qs, the S&P 500. So the S&P 500 is about 17.65. I don't even know why I was compared against the Qs. Sorry about that. So yes, the SPY has basically a dividend of 1.3%. That's pretty much, like I said, non-obsolete. And then you got 17.65% up. So it's not that far off, right? Still 11% upside out of this ETF, and it pays a monthly income a yield of 7.57%. Obviously, you divide that by 12, that gets you a monthly rate, but that's an actual annual rate there. So that is one of the reasons why Jeppy is my dividend portfolio, because I'm going to get some pretty good upside from it. It pays monthly. It's got a pretty good yield. It should have quite a bit of stamina to help the volatility, so it shouldn't be quite as volatile as the SPY would be. So right now, that's probably going to remain in my dividend portfolio. And obviously, I'm going to continue to build out Jeppy even more from the $61,000 up to over $100,000 at some point. What are your thoughts on my top 3 income ETFs? Go ahead and like and subscribe and set that bell notification. All right, the last income ETF that I'm going to go over today, that's one of my favorites anyway, is the 3rd largest position in my dividend portfolio, and that is Amplify Devo. Okay, now if you're not familiar with what Devo is a actively managed ETF, income ETF, and what they're doing is they hold a basket of stocks, say 30 stocks or so, solid positions, pretty much like I have in my dividend portfolio here that you can see, and they're pretty much running covered calls against those positions. Now, they don't run against every position every single month or any time they're opening up covered calls. They kind of opportunistically, I always never get that word right, run covered calls, okay? Now they don't, like I said, so if they have 30 positions, they don't always have 30 covered calls on. Like I said, they look at a chart, they look at where the stock is going, bad earnings, something like that, and they might put a covered call on. Okay, I'm not gonna really pull up their positions right now, but what that allows that particular income ETF to do is it allows you to have some good upside as well, okay, in addition to having a monthly income from the covered calls. All right, so let's pop that one up, pop that one up here. So let's see, we got Devo here, and here is Devo right here. We're gonna compare this one against the SPY just because it has a mix of basically S&P 500 type stocks in there. Now a lot of them are, you know, dividend payers or something like that too, but so right now Devo pays about 4.95% yield, and that's a monthly pair, so that's an annual yield right there showing. You divide that by 12, that'll get you the yield, or you just take the $1.80 and divide it by 12, that should give you your payout. So this income ETF right now, Devo as it stands, is up 11%. Okay, so we have upside there like you don't get in QYLD. Okay, maybe not even in XYLD. We still are up 11%, plus we're gonna make another 5% yield. Okay, so that's the great thing about Devo. Think of Devo like this. This is the best way to think about Devo in my opinion, because I had a dividend portfolio, I still do, and I used to run covered calls against a lot of those positions in there. It became a lot of work, okay? So that's the reason why I went to VYM, and then I started running covered calls against VYM. That was kind of a pain in the butt. Premium wasn't very good, it kept running past my strikes. So then I got out a lot of the VYM and put it in Devo. They're gonna handle all that for me. Now, if you want to do the options against your dividend portfolio, you can. You'll probably make more. You're not, obviously there's no fees or anything like that you're gonna have to deal with except for commissions, but that even could be free. So think of Devo as being a solid dividend portfolio, and you're running covered calls against those stocks in there opportunistically. Okay, you're not really just running against everything willy-nilly. You're not, you're being, strategic about what you're putting on. That is exactly what Devo is doing. So Devo is a great replacement for dividend stocks, okay? So for dividend portfolio, it's a great replacement for VYM. It could be a replacement for SCHD, although SCHD has a lot more diversity to it. It has a lot more stocks in it. They're not running covered calls against it though. Now you probably could run covered calls against SCHD itself if you wanted to, if you have the time for it. Obviously, I trade options all day long, every single day in the market, and it would be too much work with a full-time job right now, plus doing YouTube, to run options in 3 different accounts. It's just too much work, so I'm just letting Devo do it for me. So looking back here at my dividend portfolio right now, there's $54,000 in there. I have intentions of draining this VYM down, this 48,000, it's 49,000 in there. I'm gonna have intentions of draining that out to 0, and then sticking most of that probably into Devo. If not all of it will go into Devo, because that way, obviously, let me just say this. With what I just said right now, don't think that I don't like VYM, okay? I do like VYM, but I still think SCHD is a more well-rounded ETF. It covers a lot more stocks in it than VYM does. VYM is missing some very key stocks like Microsoft and Apple, Home Depot, Starbucks, for example, were not in VYM the last time I looked at it. So you're missing some very crucial stocks in there. That could hurt you, it could help you depending on what happens, right? If the RUT goes down, the Qs go down, but the SPY goes up, then VYM would be doing okay, but SCHD would probably be down, right? So it just depends on when you pick it up, but don't think that VYM and SCHD are created equal. They are definitely brothers from a different mother. So my thoughts on VYM is, yes, I will be getting out of it, taking that $10,000, almost $11,000 gain, long-term capital gains, and sticking it in a DIVO because I can get more money out of it by having them run cover calls for me on the background. Plus I get the monthly payment out of it, right? Obviously I pay a little bit of an expense ratio for that, but it's pretty low. And it's probably not as low as VYM, but that's fine. So VYM does not run any recover calls or anything like that. It's not actively managed or anything like that. So I hope you like my top 3 income ETFs. Obviously I carry VYM here, BST. I might actually add, you know, RYLD and maybe even QYLD into the portfolio in the future, but it won't be a very big position in my opinion. Obviously it's going to stay below $100,000. So the last thing I want to talk about here is just this comment right here. So great video. Is there any particular reason why you choose for DIVO to be 150K and Jeppy NUSI to be 130K? Now what he's talking about right here, Joshua's talking about right here, is I did that video, let's see the video right there, engineering my early retirement using income ETFs. He's talking about this page right here, and I go to tools. He's talking about this right here. Okay, so if you can see in here, DIVO's 150,000, Jeppy's 130, and NUSI's 130. Now, those are just arbitrary numbers that I came up with. Obviously, I feel that DIVO is a lot more solid than Jeppy is. I feel it's a lot more solid than NUSI is, and that's the reason why I wanted to have it built up more than, you know, than the rest, right? Like for instance here, you know, stocks is $150,000, right? Those stocks are solid plays, okay? So I don't have to worry about those. The same thing with DIVO, it's solid plays in there. They're running cover calls against it. You're still gonna get upside, and there are solid stocks in there, and they're opportunistically, you know, actually run the options against DIVO and those individual stocks. So I'm not, you know, I still think that that's a more solid play than XYLD is, NUSI, QYLD, Jeppy, for example, okay? Now, obviously, you can rank all these ones and say, okay, this is the next safest one, this is the next safest one. I'd say Jeppy and NUSI are right up there as being pretty safe. BST, that's pretty safe too. Say RYLD, QYLD, and XYLD are probably the least safest out of every one of those income ETFs there. So I hope you enjoyed this video of my top 3 favorite income ETFs. What is your favorite? What's your favorite income ETF? Comment down below. If you have any questions, comments, concerns, go ahead and leave a comment down below, or you can shoot me an email or hit me up on Twitter or Facegram. Until next time, please go ahead and like and subscribe, and we'll see you in the next video. Thanks for watching.